Hi, Thrivers. If you're watching this and you're going through or have been through a divorce and you weren't the CFO of the family finances, this video is for you. Whether you're buying out your spouse, buying a new home, or refinancing to get your own loan, I'm going to break down what a mortgage really is, how the process works, what affects your interest rate, the difference between FHA and conventional financing, how the deed works and all this, and a few property quirks most people never hear about until it's too late. I want you to feel confident and in control as you make one of the biggest financial decisions of your post-divorce life. So, let's get right into it. A mortgage is simply a loan for a home. The home is the collateral, which means if you don't pay, the lender can take it back. Most mortgage payments include four main components, often called PITI or PITI. And all that means is P is for principal, the actual amount you borrowed. I is for the interest, the cost to borrow that money, shown as a percentage called an interest rate. T is for taxes, your property taxes, which go to your local government. I is for insurance, homeowner's insurance that protects your home and belongings and protects the lender too. And sometimes if you put less than 20% down when buying or refinancing above 80% loan to value, meaning you're borrowing 80% of what the home is worth, you may also have mortgage insurance. That doesn't protect you, it protects the lender in the event that you default on the loan. So step one, before you shop for homes or start a refinance, you need your financial snapshot. First of all, income. This is going to be an important component of what a lender is going to look for. This includes your salary, if you're self-employed and qualifying for support income, if you're using spousal or child support. FHA financing requires at least 3 months of documented receipt of that support, and conventional loans required 6 months. And both of them require proof that it will continue for at least 3 more years after you close the loan. Second, debts. All of your debts, credit cards, car loans, student loans, personal loans. We're going to be looking at the monthly payment, not the total amount necessarily, but the monthly payment that you're required to pay, the minimum amount. Third, your credit score. Higher scores usually mean better interest rates. It's a really important thing to know what your credit score is. And finally, cash for a down payment or closing costs. For buying, that's your skin in the game. For refinancing, you need equity in the home instead of cash. The next two things often get mixed up all the time. Pre-qualification. All that means it's just a quick estimate based on what you tell the lender. No documents are exchanged or verified. Pre-approval. That is when the lender reviews your actual documents, pay stubs, bank statements, tax returns, and your divorce decree if necessary. This is proof you're ready to buy or to refinance. If you're negotiating a divorce settlement or a buyout, pre-approval is critical before you agree to numbers in writing. What's the difference between an FHA loan versus a conventional loan? Here is the really simple version of that. FHA loans are backed by the Federal Housing Administration. They're great if your credit score is lower or your debt to income ratio is higher. The minimum down payment is 3.5% when buying, and for a buyout refinance, you need at least 3.5% of equity in the home. FHA is more forgiving on your credit, but stricter on the property conditions. If there's any major repairs that are necessary, those usually have to be fixed before closing. FHA also requires mortgage insurance for the life of the loan. Conventional loans follow Fannie Mae or Freddie Mac rules. They're stricter on credit scores, but more flexible on property condition. Down payment can be as low as 3% for first-time home buyers, and mortgage insurance can be removed once you have 20% equity in the home or once the principal balance reaches 78% of what you originally purchased the home for. So FHA is easier on credit but harder on the property. Conventional is harder on credit but easier on the property. So what affects your interest rate? This is really confusing a lot of times for people because they look out online or they look places and they see a really great rate that seems unheard of in the market that they're in. Well, rates aren't a one size fits all. They change daily and they're based on several factors. Your credit score, your down payment or the equity in the home, the type of loan you have, FHA, conventional, VA, or USDA, the term of the loan, like 30 years or 15 years, whether or not there's points included with the rate. And what that means is it means there's a fee up front to get a lower interest rate. And sometimes it's in the really small print when you're looking for interest rates. It can be really deceptive because a number that you can easily overlook. Your debt to income ratio can come into play. And the property type. Some properties like condos can have slightly higher interest rates depending on your down payment. So here's a little known fact. Some loans are easier on credit dings but stricter on property like FHA. Others are stricter on credit but more flexible on the property like a conventional loan. Let's talk about deeds because this is one that trips people up a lot. The deed is the legal document that shows who owns the property. It's completely separate from the mortgage, which is the loan on the property. You can be on the deed and not be on the mortgage. That means you have ownership rights, but you're not financially responsible for the loan. You can also be on the mortgage and not on the deed. This is really rare, and most of the time a lender requires that you're on the deed if you're on the mortgage, but I have seen it. But it means that you owe money but don't have legal ownership. In a divorce, if you're keeping the home, you want your name on both the deed and the new mortgage. If your spouse is being removed, the title company will prepare a new deed, often called a quitclaim deed or a warranty deed, at closing to transfer ownership fully into your own name. Remember, changing the deed alone doesn't remove someone from the mortgage. The mortgage is a separate legal obligation that only goes away with a refinance, loan assumption, or full payoff. The mortgage process itself, let's talk about that. I know a lot of times it can feel very overwhelming and stressful, especially if you were not involved previously in this process, because it's many times people don't go through the buying process or the refinance process more than a couple times, 2 or 3 times in a lifetime sometimes. So step 1, pre-approval. Know exactly what you qualify for before you start shopping or finalizing any kind of buyout terms. Step 2, house hunting or buyout agreements. For buyers, this is finding a home. For buyouts or refinances, it's agreeing on the number or the amount in terms of your divorce. Step 3, the application and disclosures. You'll complete a full application, and within 3 business days, once you decide to move forward, the lender will give you a loan estimate that outlines your rate, your monthly payment, and your closing costs. Step 4, processing the loan and the appraisal portion. The lender verifies your info, orders an appraisal to confirm the home's value, and has the title company check for any liens against the property. The next step is underwriting. This is the final review of your file. FHA will require that the home meets certain property standards. Conventional is a little bit more flexible on that. And then closing the loan. Finally, once the underwriter checks all the boxes and everything looks good, then you'll go to closing. You sign new loan documents. The new deed is recorded showing your ownership. Any funds are dispersed and you officially own or keep your home in your own name. And here's 3 really big things to watch for. One is removing a name from the deed does not remove them from the mortgage. Only a refinance or a loan assumption can do that. Number 2, if you need support income to qualify, time your application so that you meet the 3 months for FHA or 6 months for conventional requirements. Sometimes before you apply, if you're working with a divorce mortgage specialist, we a lot of times take a loan application and then start collecting those documents over time so that once the 3 or the 6 months is up, we have all the documentation and can move forward. And 3, for buyouts, make sure your divorce decree clearly states the amount and the timeline. You don't want to sign up for something for refinancing a home in 90 days if you need support income and you're seeking a conventional loan. You need 6 months of receipt. Whether you're buying out a spouse, buying your next home, or refinancing after a divorce, the key is to know your numbers, understand your loan options, and plan for the timing. So let's reset, rebuild, and rise. If you want my checklist so you know exactly what to gather before you start, go down in the show notes and click the link for the divorce mortgage guide. That'll be a really good start so that you can start on the road to recovery and understanding what all of your options are. Thanks so much for watching, Thrivers. Please click the subscribe button and the like button. It really helps me to know that these videos are meaningful and making a difference. Thanks so much for watching.